Welcome back to Curious Commerce, Capital Budgeting Series, Part 12. Today we are going to understand a concept that confuses almost every finance learners. Let me start with a simple question. Depreciation is a non-cash expense. So logically, no money is going out of the business. Then why do companies consider depreciation while making investment decisions? If there is no cash outflow, why should matter at all? And most importantly, what is the real impact of depreciation on cash flows? By the end of the session, you will clearly understand why depreciation is not just an accounting concept, but a powerful financial tool. Before we understand the concept, let us address a very common misunderstanding. Many learners assume that depreciation is irrelevant because it does not involve any actual cash outflows. They think no cash is paid, so no impact on decision. But this assumption is incorrect. In finance, we do not only look at direct cash movement, we also consider how accounting numbers affect tax payment. And that is where depreciation becomes important. So even though depreciation does not involve cash directly, it indirectly affects the cash flow through taxation. Let us understand what depreciation actually means. Depreciation is the allocation of the cost of an asset over its useful life. For example, if a company purchases a machine for rupees 1 lakh, it does not charge the entire amount as an expense in 1 year. Instead of that, the cost is spread over multiple years. This is called the depreciation. Important point to remember, it is an accounting expense. It does not involve any actual cash outflows. Depreciation reduces reporting profit. So once again I will repeat, depreciation reduces the reported profit. So the depreciation affects profit, but not cash directly. Now we come to the most important idea in this topic. Although the depreciation does not reduce cash directly, it reduces the company's taxable income. When taxable income decreases, the tax liability also decreases. When the taxable income decreases, the tax liability also decreases. This results in tax savings. And the tax saving mean that the company retains more cash. That means that the tax saving means that the company retains the more cash. So indirectly, depreciation increases the cash flow. This is the key concept you must remember. Depreciation is a non-cash expense, but it creates real cash benefit through tax savings. Depreciation tax shield. This concept is known as the very important and the Understanding the depreciation nature, a tax shield refers to the reduction in tax due to allowable expenses. In this case, depreciation reduces taxable income and therefore reduces tax. The formula is very simple. The tax shield equals depreciation into tax rate. This means higher depreciation leads to higher tax savings, and higher tax saving result in higher cash inflow for the business. So, depreciation act as a shield that protects part of the income from the taxation. Let us connect this concept to cash flow calculation. In capital budgeting, we are interested in operating cash flow. The formula is operating cash flow equals profit plus depreciation. Why do we add depreciation back? Because depreciation reduced the profit, but it did not reduce the cash. So, to arrive at actual cash flow, we add it back. Additionally, we adjust for taxes to capture the tax saving benefits. This ensures that our calculation reflects the real cash movement in the organization. Understand this with a simple example. Depreciation or the calculated depreciation is 20,000 rupees. Tax rate is 30%. Tax shield is the formula as the depreciation into tax rate. That is 20,000 rupees into 30%. The tax shield is 6,000. This means the company saves 6,000 rupees in taxes. This rupees 6,000 is not an accounting figure, it is the actual cash saved. So, depreciation, even though it is non cash, creates a real financial benefits. Let us understand why this concept is important, why the depreciation concept is important. Depreciation plays a crucial role in the net present value or the internal rate of return, what we call as in the famous and popularized capital budgeting techniques, that is NPV and IRR. Both these methods are based on cash flows. If you ignore depreciation, you will underestimate the cash inflows. This can lead to wrong investment decision. Therefore, understanding depreciation is essential for accurate project evaluation. From a manager's perspective, depreciation is not just an accounting adjustment, it is a strategic tool. Managers consider the depreciation carefully because it reduces the tax liability, it improves the cash flow, it increases the project attractiveness. A good manager always focuses on the real cash impact rather than the just accounting profit. Let us quickly summarize what we have learned today's discussion. Depreciation is a non-cash expense. It will reduces the taxable income. Depreciation creates the tax savings. It increases the actual cash inflow of the organization. So, Even though no cash is paid, depreciation has a significant impact on financial decisions. In the next session, we will move to another important concept, that is payback period. This will mark the beginning of investment appraisal techniques. If you found this session useful, make sure to follow Curious Commerce for more such concepts explained in a simple and practical way. Please like, share, and subscribe. Thank you. Thank you, one and all.